Hey guys, Landy here, and I want to welcome you to Landy's Crypto Corner. Today is March 26, 2023, and the banking crisis continues. And Bitcoin, well, it's holding at the highs, at least within the range here. And I did want to quickly touch on the banking crisis that's currently happening as it relates to the bond market and, well, depositors and investor mindset and how that might benefit Bitcoin. When looking at what the Fed is doing here, they are utilizing the Bank Term Funding Program. They're utilizing this program, and while doing so, they're providing liquidity to the banks for many different reasons, but primarily what they're stating is for the depositors that do not qualify for FDIC insurance. Now, we do see that their balance sheet has exploded more than two-thirds of their more than a two-thirds increase in their balance sheet here as they provide liquidity and just generally saying the US dollar liquidity, or boost US dollar liquidity. We also see things like UBS buying Credit Suisse. Credit Suisse had a giant gaping hole in their balance sheet. And, UBS, they also have giant holes in their in their balance sheet. So I don't know about that, but, there's articles out there everywhere about this. We see depositors, in regional banks basically fleeing to the larger players in the banking system. So what does this mean? Well, we're going to jump away from the Bitcoin chart real quick here, and we're going to look at bonds. And the reason why we're going to look at bonds is because banking deposits are a liability, and you need to offset that liability. I mean, this was the whole situation with SVB. Is their bonds were low yield bonds that they had, or treasuries that they had on the books, and they took a massive loss on that. So without getting into the whole story in specifics, I do want to address what's going on in the bond market, because when depositors are a liability and you're taking on more liability, you need to offset that liability. And what do? You buy bonds. Now, the main reason I want to look at the bond market is because yields are dropping, and I do believe that they will continue to drop. When looking at the 2-year treasury here, you can see that the monthly is currently painting an unconfirmed bearish engulfing candle. If it does get a closure like this below the 9 EMA, I would expect bond yield rate on the 2-year to start working its way down to right around 3%, maybe a little bit north of 3% over time. When looking at the quarterly as well, we can see that this is a reversal structure with targets down to, again, around its base of support back here at around 3% or so, right there at just under the upper first standard deviation of these Bollinger Bands. So we're seeing the same thing when looking at the 10-year. If we go to the monthly, we're not seeing a bearish engulfing candle just yet, but closure below the 9 EMA, I'd be targeting around where the 21 is probably going to update to at the end of the month here, as we're in the last week of the month. And that's coming in right around that 3% is where I expect it to be, all the way down there to the 200 EMA basis band, 200 SMA, which are quite a bit lower, almost 2.6, 2.7%. But, it's painting the picture that yields are going to fall. We have the money or liquidity being injected by the Fed into the banking system itself. So what are they using that for? To hedge? Well, they're using treasuries, which is going to create an environment where the yields are going to continue to fall. And we can see that when looking at momentum as well. The 10-year monthly here, Stoke is now pointed down. And we see the same thing for the 2-year. Stoke is pointed down. And the big one is, going to be the quarterlies, right? So we saw the quarterly is painting a reversal structure on The 2-year, it's painting a reversal structure across the board, across the entire treasury market. But here on the 10-year, for instance, we have targets down to around that upper first standard deviation coming in at 3.1% to around that 9 EMA, which is quite a bit under at 2.768%. Now, when looking at the quarterly, it is relevant to look at that 9 EMA down there, as it will most likely take a while for things to get there if they do. Now, that being said, I'd want to see a closure below the wick low here on the quarterly for the 10-year, for instance. And we are starting, we have this inversion of higher rates on the 2-year over the 10-year. And I do think that that's probably going to quickly revert. And we'll see how quickly that happens. But why am I bringing this up? Well, as it relates to Bitcoin, when you have a large exodus of depositors from regional banks, you're getting more centralization within the central banking system. I mean, it is in the name, but now we have more people looking at Bitcoin as a potential safe haven, whether it's, to hedge, there's other things going on where the fiat ramps through some of these banks have been cut in terms of buying, Bitcoin or other cryptocurrencies, utilizing some of these exchanges, your Coinbases of the world, your Binances, so on and so forth. You most likely, if you're watching this, what's going on in that sector in terms of many of these exchanges not being able to accept fiat deposits or withdrawals. So that has to do with their ties with the banks getting cut. But the flip side of that is many of the larger players are now opening the doors to allow investors to buy Bitcoin and Ethereum. So we'll monitor those stories as they continue to come to light. But the charts will tell you the news well ahead of time before the news story comes out. So I prefer to watch the charts here. And when looking at Bitcoin here, still staying above that 9 EMA there at 27,420 or so. If we do see things trade back above the upper first standard deviation here, which is coming in at 28,288, so basically 28,300, well, that would be running the range highs here on a closing basis around that 28,350. If we did see intraday price action start to trade back above, then I'd be looking for the wicks just below that $29,000 there. If we did see a breakout, I'd look to the upper second standard deviation there. That has updated to 31,145. If we did see the 9 EMA close below specifically on a daily, then I'd be looking to the 21 EMA down to the 20 basis band there, and that's coming in at 26,100 down to the 20 basis band at 25,430 or so. Anything below there, we start, drastically lowering those targets down to around the upper first standard deviation and 200 EMA over time. Not right away, but over time, wherever those would come in. So I don't think those numbers are as relevant right now, down at 22,500 and 22,477. Basically, they're $100 apart right now, that 200 EMA and lower first standard deviation. So I don't think those are relevant right now for at least for today. But I do want to take a look at some of the confluences for these areas. As we can pull a fib extension. I showed this in the last video, but you can see that the 9 EMA is right here at the 50% fib. And if we did drop that, where's the next target? The 382. This is coming in at right around where the wick lows are of the current consolidation range at 26,600. If that area is dropped, then we start looking to around the 21 EMA down here to the 20 basis band. It's coming in at the 236 of this Fibonacci extension. So pretty clear that the area that we're in right now at the mid $27,000 currently trading above there and rejecting in the lower term timeframes and in the open here today around that 618. It's pretty clear that if we can trade above it, we're going to go retest the highs. We can trade above there. We see the one spot extensions coming in right around that second standard deviation high, just shy of $31,000. If we did drop around this 236, 24K is going to be the area that needs to hold up around these wick lows, just under 24K there. But when we add some more confluence to this by looking at the Renko chart, if you haven't seen it before, I've got a few videos and a thread that's going to be linked down in the description even. Wow, really jumbled that sentence up. But the Renko chart is pretty telling in this case. So let's go ahead and turn off the fibs here and prep the Renko chart real quick. And we'll look at some of the confluences that are coming in from there and compare that to our regular candlestick chart. When looking at the Renko chart and then throwing on the support and resistance areas that I noted in the last long form video, you'll see that dropping $27,000. If we did drop that, we would paint a projection candle down to the $26,000 area. Now, I got some questions about this, and I really thank you for your questions. Please keep bringing them because it helps me better explain what's going on, especially when they're new concepts to many of you, like the Renko chart. In this case, we would not see an actual red brick paint or confirm. We would just see a projection brick paint, and that would be down to the $26,000 area. If we closed a daily on a regular candlestick chart below $26,000, then and only then would we see a red Renko brick paint. And then that would, of course, lower targets from the $26,000 area. Then we'd be looking to around that $25,000 to $24,000 area, right around where we saw the zero read of the Fibonacci extension come in. That would be dropping that 236 as well on a daily. So when pulling back in that fib, we can see that if we dropped the 236 right here, we're starting to look for primary supports, and that's going to be the $24,000 to $25,000 areas. So we've got most likely good support down here, and I would expect, bounces from there and then we reevaluate. But the reason that I bring this up is that if on the Renko chart, when you are using the Renko chart, you're not going to see a brick confirm, a new candle or brick confirm until we saw a daily closure below $26,000. And this is where it can get a little confusing for some. Because we're not using a fixed box size or a fixed price range. So price moves $1,000, then it prints a new brick. Well, it would still have to close that on the regular candle chart. That $1,000 move would have to close for it to be calculated. The same goes for ATR. So we're using an ATR period or an average true range with a period of 14. So 14 candle look back or 14 period look back. And in this case, when the daily closes is the only time that calculation runs. So we would need to see a daily close below the $26,000 area for that to actually lock it into the calculation and to paint and confirm that red brick. If a daily did not close there, we would not see a red brick paint. So I just want to call that out. And in fact, if we saw a move down here on the regular chart and then it gets bought back up, and specifically we start closing back up above $28,000 on a daily and then subsequently close above 29, that's where you get these wicks. So the price moved down, never closed and confirmed on the daily down there on a full brick closure, which down here would have been this brick low at $20,000. We didn't see the ATR actually run that calculation and take that into account because it's using the 14 period look back. By the time it ran the calculation in the next daily closures and calculated all the the remaining candles behind or back behind the candle that just closed, we had already started to come off the lows and paint a new brick up. So this turned into a wick. So I want to be very, very specific about that. If you still have any further questions, keep them coming. I'm going to be integrating them into my Renko charting masterclass. So I want to thank you for that feedback. And if that wasn't clear, just know that the daily's got to close below $26,000. It'll paint a red brick. If the daily starts closing above $29,000, that's where we would paint a green brick. And then we start targeting, $30,000, $31,000, $32,000. So now let's keep this on the chart momentarily while we flip back to a regular chart. So we're going to go back to regular candles here. And you can see that, the support and resistance areas, we've got an order block right here. And that order block is going to be the big area if we do see price fall below and start closing below $27,000 and subsequently below $26,000. Then we start targeting this area at $24,000 to $25,000 at the previous range highs and that order block candle before lifting off to new highs. So we do see that BBWP is cooling down, and we do see that Stoke is also turned down. So Stoke is pivoted at 28,290, so basically 28.3. That would imply that that price trading back up to the local range highs, like I called out in the Bollinger Band portion here. We see a closure up there. We'll get an initial cross back up on the daily, and then we can start targeting, if it didn't already hit that area, the wick highs at around $29,000 with the possibility of a breakout higher to around $30,000 to $32,000. So that's the daily. I do want to call out that we are nearing the end of the month, and we had a few major closures. So we had the weekly close here. We did paint a doji. If we close below the wick low, which is coming in at 26,678, again, that fills the daily criteria, closing a daily below $27,000, then lowering those targets to the downside to around the 26, 24 to 25 area, so on and so forth. That's, if we closed a weekly down there, strong possibility that we're going to go back and run this area again. If we do see a weekly close above that $29,000, we're probably going to run to the next bigger area, which is going to be on the weekly. We have an order block right here, and the low side of the open, the close. The close is going to be the high here. It's just shy of $30,000, $29.99. The open down there is going to be the primary resistance for the close open, is what I was trying to say. Close of the bear candle, open of the bull candle at 29,500 or so. So that's going to be an area intra-week to look at, especially if we see a weekly pop up and close above $29,000. We will most likely have ran that area from a daily standpoint. So we did have a 2-week and a 4-week closure. And this is kind of big because the 2-week has done something that we have not seen, in quite a while. And let's throw on the Bollinger Bands here, and you'll see exactly what I'm talking about. And that is a closure. Let's take off the Renko support and resistance here. Excuse me. This is my second time trying to record this. I had some technical difficulties earlier, so my voice is starting to fail me. I apologize. But we've seen now on the 2-week closure, which just closed with this past weekly candle, that we have closed not only above the first standard deviation, which we were finding resistance at on the 2-week, around that 21 EMA, but we've popped up above the 21 EMA, the first standard deviation, and the second standard deviation to the top side here, or the upside. And that second standard deviation is coming in at 27,730, 740 area as price kind of oscillates around. Upper third standard deviation is now updated to $31,000. Now, the reason why this is so important and why I'm calling this out is because we have not seen this since while the most recent upper second standard deviation closure on the 2-week was on August 20th. I'm sorry, August of 2020. And shortly after that, we went sideways down and tagged the 9 EMA and then took off. Well, where's the 9 EMA? The 9 EMA currently is right there at 27,300. The 21 coming in just above there at 24,261. Now, the last time before that Bitcoin popped above the second standard deviation to the upside here was coming off of the bear market bottom. And that was in May of 2019. So something that we don't see often is break down below the second standard deviation and breaks above. Now, you can see what happened. We did have a bearish candle, a nice bullish candle that closed just below the third standard deviation to the upside, and then a big old wick outside of the top side there. Based on what we were just looking at earlier with the distribution range above the daily distribution range above where price action is right now, that third standard deviation becomes a very, very big area of interest for both bulls and bears. So a target for bulls and a potential entry point for bears. So I wanted to point that out. We closed the 4-week and the 20 basis band is right there at 30,853. So coming in right around that $31,000 area. So again, we've seen a closure above the 21 EMA, and we are looking at the 9 EMA down here coming in at just shy of $25,000. Again, in that big area between $24,000 and $25,000 at 24,886. I think it just fluctuated to 885 or something like that. Now, the other big closures, we've had a lot of them now. And then we've got, at the end of this week, we've got the weekly. Of course, we're going to have the weekly at the end of this week. The monthly and the quarterly. Well, the monthly, we are currently trading above the 21 EMA, well above that lower first standard deviation that has that nice wick right into it. And if the monthly does close here, we are looking to run around the next monthly open because there's really no other candles in this area outside of this guy here from December of 2020, which is coming in at, that's a closure in this case, coming in at 28,990. Hey, what about that 28,990? Well, we wicked 28,937 so far. So if we can trade above that closure, we then look to the open of the monthly candle at coming in from June of 2022, and that's coming in at 31,784, which fulfills that Renko chart's distribution range highs, which are coming in at $32,000 right there at that wick high of that candle. So it is worth noting that the wick high there was 31,964, and that was that's going to be the same on the daily as the monthly, right? So the other big thing, the other big thing about the monthly here, which I do think is very important to watch, is the range that we're breaking out of. And the range highs there are going to be 25,288. If we get a monthly closure above there, then I am looking for continuation up to around that $32,000 area. Now, the big one is going to be the quarterly here. The quarterly is clearly painting a reversal structure, and its downside area to beat for where price is trading right now versus what it needs to beat out to the upside, I should say. Not the downside, but underneath of us here, that 25,207 area. And in this case, This is going to be 25,214. It's 25,207 on the index. My apologies. So 25,214. Well, if we see a quarterly closure above there, and especially above $27,000 or so, above this 9 EMA here, I would be looking to substantially raise those targets over time. Of course, the next most relevant area is going to be the close back here. Again, this close is coming in at 28,990. And from there, we're looking at wicks around that area as well. Wick lows 28.8, where I've already tested in and around that area. Another wick low at 29,300. But then we're primarily looking at the closures up here at around that $35,000 area for the quarterly. So keep in mind the monthly and quarterly, you want to see them close above around 25,300 or so. That would preserve the long-term timeframes charts projection or possibility for further upside as we go forward into the new monthly and new quarterly. Now, to note momentum on the quarterly, we're going to see this update. We had high volatility coming up. We come down. We go into consolidation. The only way that we're going to see BBWP or volatility increase on the quarterly is back above around $38,000 or so, above that upper first standard deviation. Now, the momentum pivot for the quarterly is going to be pretty important too, because this is going to update as well. Right now, it's currently at 46,500 or so. And this is going to probably come down to, low 40s, upper 30s, which, go figure, excuse me, are going to be right around that upper first standard deviation on the quarterly as well. When going back and taking a quick look at the monthly momentum, you can see that this is a mean reversion play because we went from one side of the Bollinger Bands to the other. We got expansion after passing the basis and then closing below the lower first standard deviation. We began to expand the Bollinger Bands to the upside here. And in this case, expanding the Bollinger Bands, not to the upside, but to the downside here. We track sideways, expansion begins to flatten out, or BBWP begins to flatten out, cross under the moving average here, indicating a mean reversion play, while Stoke is pointed to the upside, which gives us further confluence that we are going to most likely be looking for price action to trade higher. And in this case, the monthly momentum pivot right now is going to be $17,000. So we're pretty well far above that area. 10K drop in the next few days would be kind of crazy, but I think we'll be preserving that momentum pivot for at least the rest of this month. So that's kind of all I got for you on Bitcoin right now. I will have a short video tomorrow. I'm kind of doing one day long form, one day short form video, or a shorts video. It'll just be a quick 60 sec. Sorry, I'm losing my voice. It's starting to go. So sorry. It'll be a quick 60-second update, and then we'll kind of go from there. I want to wish you guys a good morning, afternoon, and evening, no matter where you are in the world. Please trade safe, and of course, stay safe. If you like this content, go ahead and like and subscribe and share with anyone that you think might find it helpful. With all of that being said, Landy out.